One matter that affects all UK taxpayers and also consumers is something called fiscal drag. What a term. In today's video, I'm going to explain what fiscal drag is, more importantly, why we need to understand what fiscal drag is and how we can, in terms of taking some planning arrangements, mitigate the tax exposure that we face. If we ignore it completely, then we're going to have a real financial squeeze in our pockets, in addition to those financial squeezes we feel through prices going up and the like. First of all, what is fiscal drag? Now, when things like inflation go up, when the cost of commodities and prices go up as well, it sometimes happens, and it's happened in the UK, that the Chancellor does not adjust the tax breaks that taxpayers get, and more and more people are dragged into a tax net. So, for example, in the United Kingdom, we have three bandings that we have for paying income tax. There's a basic rate tax, which is essentially, after your personal allowance, approximately £37,500 is what you can earn from profits from your self-employed business, renting out property, your salary, etc., and you pay tax at the current rate of 20%. Once you go over the 50,000 total income, and these figures are approximate, by the way, check out the website for more detailed rates. Once you go over that, up to the next £100,000 and beyond, up to £150,000 for 23-24, you pay what's called higher rate income tax, currently at the rate of 40%. Once you go over the £150,000, then you pay an additional rate of tax at 45% on that excess income. Now here's the kicker. Personal allowances, currently £12,570 for 23-24, are frozen for a good number of years until about 2028. What that means is, as wages go up to try and keep pace with inflation, as your employers try to retain good quality staff, as you as a business owner have got to put prices up to cover those additional costs, your income by nature is going to increase as well. And what that means is, where you may have been a previous rate taxpayer paying at basic rate, you're now going to be pushed into likely at a higher rate band. And depending where you fit on that income scale, you're going to go from a higher rate banding to an additional rate banding. Now there's an additional squeeze. From April 24, the limit is being reduced now from 150,000 to 125, where when you've got income going over that limit, you're paying additional 45%. So by the law of, I would say, intended consequences, a lot more taxpayers are going to be pushed into the higher tax net. Allowances won't be keeping pace with inflation, let alone CPI. Increased prices impacts on increased wages, and even if you do nothing more, you will be ending up paying more tax. Now, there are other allowances that have been frozen that give us that conundrum as well. Now, before we look in terms of what we can do to mitigate that, there's also another impact in terms of allowances being frozen. So for those businesses currently who decide to register when they have to, when their 12-month rolling forecast turnover hits 85,000 and above, that's the threshold for having to register for VAT, those thresholds are frozen. What effectively that means is that your business, if your prices are going up, which will be happening to a lot of businesses just to keep pace with things, then that will mean that your 85,000 threshold will be hit much sooner. You will then have to start charging VAT on your goods and services, which means your customers will be paying higher prices if they aren't indeed themselves VAT registered. So we've got an understanding of what fiscal drag is, what a lovely term that is. We've looked at the impact on that, but what can we do in terms of planning for it? Now I'm going to give you a few general overviews here, and in next week's video, I'm going to dive a little bit deeper into some tax planning that we can consider. Now this is general overview advice. I thoroughly recommend that you either speak to your current advisor, your current accountant, or book a call with us to see where we can help you mitigate that tax burden. So if you have no pension scheme at the moment, it's advisable that you set one up, not only just to save for that inevitable date of retirement, but also making contributions to a private pension scheme has the impact of reducing your tax exposure. If you make donations to a charity, and having done thousands of tax returns over the years, many individuals don't necessarily keep a track of the donations they've made to charity, and those gift aid donations, as they would be called, have also the impact not only of you doing good stuff, but also reducing your tax exposure as well. There are other investment products that you can look at which will mitigate and reduce that tax exposure, but it's really more critical than ever now that you consider, if you're in business, that you look at the tax planning landscape, not just for your company or your self-employed business, but you as the individual and your family as well. Folks, I hope you found this video useful, and if you have, I'd love it if you could share it with those who you feel will benefit from that. If you've got any comments to make, I'd love to hear from them. And until next week, don't get stressed out, beware of fiscal drag, because you are going to be dragged into that tax net sooner rather than later.